Hi guys, welcome back to Father and Son Investing. Today's video is going to be for I-bond holders to let you know what the expectations can be for your I-bonds as we get closer to that November 1st announcement about what the new I-bond interest rate will be. Today is an important day because the consumer price index numbers were released today, September 13th, and this is what they show. The CPI is Consumer Price Index. For all items, rises 0.1% in August. There is some good news and some bad news in here. Shelter and food increase, and the good news is that gasoline is falling. Certainly that dropping fuel cost is what is offsetting some of the shelter and food increases. Now, I want to make sure that I-bond holders understand exactly how their I-bond interest is getting calculated. It gets a little bit confusing because they report this number year over year, 8.3%, and you may be thinking that, if that holds up, that your next I-bond interest rate is going to be around 8.3%. That is not the case. That is a year over year or an annual change, and your I-bond interest is calculated on a semi-annual inflation rate. Those numbers come from March and September of each year. And the difference between those, March and September and March, is what your next 6 months of I-bond interest will be. I'll show you exactly how that gets calculated in just a little bit. First, I thought it would be interesting, though, just to take a quick peek at how these numbers break out by regions. Now, of course, 8.3% is the U.S. city average, but they also break this out by regions, so you can get a feel, depending on what region you live in, how the numbers are doing. For instance, if you're in the Northeast, it's only 7.4% year over year. If you live in the South, you're looking at 8.9%, and various regions in the South are over 9% up to 9.4%. They also have this broken out by some large cities within the United States, and so you can get a better feel of how inflation rate is doing for you or members of your family. If you live in the Phoenix, Mesa, Scottsdale, Arizona area, well, I'm sorry, you're looking at 13% inflation year over year, and even just since June, it's still up 0.8%. If you live in the Atlanta, Georgia area, your year-over-year rate is 11.7%, and for you, the inflation rate is not necessarily slowing. Since June of 2022, it's still up 1.3%. If you live in Alaska, well, things are looking better for you since June. Things have gone down 4%. So once again, the annualized inflation rate is 8.3%. We can see that right here for August of 2022. And when we looked at the CPI-U, the U just stands for urban customers. When we look at that consumer price index for all urban customers, they're saying 0.0. You're going to see 0.0, 0.1. These numbers can get a little bit confusing. You can also see the CPI-U, and that is 0.1. And really what that column is, it tells you what consumers are starting to do when things get expensive. Of course, you may start to be choosing less expensive brands. Instead of buying that brand name washing machine detergent, you may start choosing the store brand instead. And so that gives you an idea of how prices are doing when people start adjusting what they purchase. Now, I want to show you this quickly because this is how we're going to estimate what your I-bond might be doing. Again, remember, the important months are March and September. There is some confusion out there about that. In fact, I got a comment yesterday saying that one of the videos that I made was absolutely wrong, and they were saying that the interest rate for an I-bond is calculated based on the average of what inflation has been over the preceding 3 months. Trust me, this is the way that the interest gets calculated. You can read this on the treasurydirect.gov website if you want to confirm this. So what we're looking at is something called a CPI-U number. Just know that it's based on the period from 1982 to 1984. You can call that a CPI-U number of 100. And essentially what that tells you is that something that cost $100 in January of 1984 is now going to cost you about $296. That's how you can kind of equate these CPI-U numbers. So the CPI-U number for August is 296.171. You can get that right from the Treasury, you can get that from the Bureau of Labor Statistics website. That's where I got that number. That number is 296.171. We can see that essentially since June, that number really hasn't changed. And that goes along with what the Bureau of Labor Statistics has been showing for the last two reports. If you like to see these things graphically, you can see that here. This line just flattens out. This also gives you a good idea of just how inflation has taken off really since about September or October of last year. Now, if you're wondering how that interest rate that you're currently getting of 9.6% came about, what they did for May of 2022 when that interest rate was announced, they took the current CPIU number, that's this 287.504 in March of 2022, and they used the CPIU number from September of 2021. It's a very simple formula. You take the current number, subtract the previous number, and divide by the previous number. That will give you the semi-annual inflation rate, which is 0.48 or 4.8%. You double that to get the annualized rate, and that's how they came up with 9.6%. Now let's just talk about a couple of scenarios here. What if the Fed manages to keep this flat? Quite honestly, the video I did 2 months ago, I didn't think there was any possibility that they could do that, but they've now done it pretty much 2 months in a row. So let's assume that they just keep it flat. So there's no change. This will be the CPIU number then. We do the math, and it comes out with a semi-annual interest rate of 3%. You double that, you've got 6% is what you're looking at on your next I-bond interest rate if the Fed manages to keep inflation flat. Now, let's say that it just happens to squeak up to 0.5% for the month of September. And I'll actually I'll show you where you can get a good estimate of what it's currently projected to be for the month of September. But let's say 0.5%. That's going to be your CPIU number. You do the math, and you're looking at a semi-annual interest rate of 3.5 and an annualized interest rate of 7% for your I-bond. Let's say that it's just the average of what it's been year to date. I did just added up all the numbers and divided by the 8 months that have happened so far. That comes out to 0.76%. The month-to-month inflation rate is what we're talking about here, month-to-month. There's your CPIU number, and the semi-annual interest rate is 3.8, and you double that, and you're looking at 7.6% annualized. Now, where did I come up with this 0.33%? Well, I want to show you something. I actually showed you this in a video yesterday, so if you haven't watched that video, go watch that. You'll get more information about this particular website. This comes from the Federal Reserve Bank of Cleveland, which is a branch, of course, of the Federal Reserve Bank for the United States. They have something that they call inflation nowcasting. Watch the video from yesterday if you want more details about it. The Federal Reserve Bank of Cleveland predicts day to day what the CPI number is at that point. So we can see that for September 13th, they're saying for the month of September we're talking about, not August, which was just released today. I know that gets a little confusing, but what the CPI, the Consumer Price Index, or the inflation rate month to month for September of 22, they're saying will be 0.33% at the present time. You can also see a graph of what they've been saying each day. So you can see at the start of the month, they were actually predicting it to be much higher, 0.53%. And in those 13 days, it's come down to 0.33%. Watch the video from yesterday. I actually talk about their accuracy in these predictions. They do a pretty good job. Every once in a while, they're off by quite a bit. So now we're going to plug in that prediction from the Cleveland Fed, and we'll see the 0.33%. There's your CPIU number, and we're looking at a semi-annual interest rate of 3.4%. You double that to get the annualized rate, and you're looking at a 6.8% I-bond interest rate as a prediction for the November 1st change in I-bond interest rates. If you're looking at all of these numbers, you're going to see here, obviously, that we're looking in the 6 to 7.5% range for the next I-bond interest rate. That is a significant change from the video that I made after the CPI numbers came out for June of 2022 in July of 2022. Now I have people asking me, should I still buy I-bonds, or is now still a good time to buy I-bonds? In my opinion, it is. If you buy it today, you're going to get the 9.6% interest for 6 months. And then you're going to get the next interest rate, which will come out on November 1st for another 6 months thereafter, because remember, you have to hold an I bond for at least a year. So you're looking, when you're doing 9.6 plus about 6 to 7%, you're still looking at an average of 7-ish% for a year, which is actually a great return for such a guaranteed rate. It's going to be hard to find anywhere else. Granted, it is only keeping up with inflation, but it at least is keeping up with inflation. So there you have it. I hope this was interesting for you, short and quick. If this was, please give us a thumbs up. We really need that. I'd encourage you to watch the video that I made yesterday talking about how you can predict what this is going to be for yourself based upon that Cleveland Fed website. And there's a number of other videos that you can watch about I bonds, the advantages, the disadvantages. Please share this information with a young person in your life. Help them get involved in investing and learn about money principles and financial ideas. Help them learn to learn for themselves. And as always, until next time, enjoy your investing.